Hi everyone, welcome to Market Outlook Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the standard format, so we'll just check out how markets are trading currently. We'll look at stocks and US stock indices and have a couple of comments on gold, which is obviously breaking to new, more record highs again this morning. So we'll just look at that as well. We'll then get into last week's main events. Not too much data really, PMI data, we'll just check those out. In the Euro area, UK, US actually, and also PCE data out of the US on Friday. So we'll just run through that before then getting into obviously this week's main events, the big one being non-farm payroll on Friday, of course. So we'll look at that. We've got some charts around that and the graphic, of course, that we normally have around non-farms. And then we also have the RBA policy announcement on Tuesday. Nothing too much expected there. We get Eurozone inflation data on Wednesday. Again, nothing major probably expected there as the ECB are on hold for quite a prolonged period at the moment. And if we have time, we'll get on to Japan as well. A few events happening there alongside the LDP election on Saturday. That's coming up. So first up then, I should say, sorry, if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those as we go, or at least at the end of the webinar. Anything we're talking about or anything you're looking at, then please do ask it, big or small, and we'll try and, as I say, answer those as we go. So markets currently, well, APAC stocks, Asian stocks, eventually traded mostly firmer following decent performance on Wall Street on Friday. Obviously, we have a pretty risk-packed week this week, culminating in that US jobs report. So a lot of focus will be on that. President Trump, he said he will discuss the looming government shutdown in the US with congressional leaders today. He believes Democrats may want to make a deal, but he added that actually if Democrats refuse to make a deal, the country closes, I think were his words. That's according to Reuters. I should say really such shutdowns, typically have limited macroeconomic impact, really. A lot of headlines around these events, but limited impact on markets generally. They could, of course, result in major disruptions in the US, and that might include furloughing for hundreds of thousands of public workers. So not obviously a good situation for them, but market-wise, not a massive impact. Although I guess some are citing the fact that gold is rallying, and one reason for that is down to the possible government shutdown. Yes, I'll leave it there with that. Trump administration otherwise reportedly considering tariffs on foreign electronic devices based on the number of chips in each device. That's according to Reuters. Then OPEC Plus, we had some headlines there, will likely raise oil production quotas for at least 137,000 barrels per day at its October 5th meeting. Again, according to Reuters. And looking at European equities, actually, they're firmer on the day after closing around up 1% actually on Friday. We're near record highs actually on the FTSE of 100 and also on Eurostoxx 50 as well, interestingly, whereas the German DAX is lagging those two as well as France, of course. If we just talk about gold, then let me just pull up the chart first of all, which is obviously one way after I think it's around a 45% rally now in gold this year that we've seen. You can just see this chart. Let me just take off these count the channels, which is kind of textbook breakouts, really. You had that textbook breakout that we highlighted a few weeks ago with 3,400, then 3,500, that previous record high, just pushing higher. And then we've had sort of pauses, healthy pauses before pushes, breaks higher really to the upside. And again, recently, sort of flag pennant type consolidation, bullish consolidation pattern, and then another push to the upside again. We are, of course, heavily overbought on the daily. This is also the weekly chart and the monthly chart. So at some point, we will get some potentially stronger correction than we have seen. Incredible rally, as I say, up around 45% or so. And that, we've said this before, actually, the precious metals already set more than 30 nominal records so far this year. I think that's around 36 now. And also the recent surge meant it has topped the inflation adjusted peak that we saw back in 1980. All the usual suspects again. Government shutdown potentially seeing this rally. Not so sure, but otherwise it's really geopolitical uncertainty still lingering, lingering inflation woes as well, possibly, along with a huge debt buildup, of course, in the US. Prospect of Fed rate cuts, of course, and then sort of key underlying sort of support or key underlying drivers underpinning support, I should say, for gold really for us. Central bank buying, huge, very strong, has been in recent years, but still going strong even at record highs. And then recently as well, ETF inflows. So exchange traded fund inflows, they have been very strong recently, positive actually for the past 4 straight weeks. And now actually total ETF holdings are near actually pandemic record highs. So those two drivers key for pushing us higher really. And two round numbers really for us, probably 4,000 is a target, 3,900 of course, then 4,000. Goldman Sachs stated or cited that as a number, and then 5,000 just for your guide. If we had sort of questions around Fed, major questions around Fed independence, and people then flocking even more to gold in that scenario. Not there yet, of course. 3,900 probably a key number, but as I say, heavily overbought on numerous timeframes. Just moving to stocks then. Interesting, we sort of have corporate headlines really underscoring two of the dominant themes around stocks then, AI, of course, and then restructuring. So last week, Intel surged after reports of early talks with Apple for an investment. That comes, of course, on top of government and foreign capital already entering the stock. Really interesting, that sort of scenario. And then we had NVIDIA committed $100 billion to OpenAI. So big news there, as well as Boeing actually deepened its partnership with Palantir, and then Alibaba actually joined the list of firms accelerating their AI spend. So just a few corporate headlines from last week. Otherwise, interestingly, the high multiple Mag 7, they lagged really, even as that narrative around AI obviously kept running hot. We had energy stocks last week. They rallied on crude strength, and then value cyclicals. So materials, energy, and banks, mentioned energy already, were particularly strong. Flip side, really, interest rate sensitive sectors, particularly consumer names, they remained under pressure. And so too defenses, actually, like consumer staples and healthcare. Weakness on pharma basically came from new tariff threats, of course, that we had last week as well. Although the downward pressure kind of dampened late Friday, actually, or Friday, really, following White House confirmation that the EU will have a 15% tariff on pharma products and not 100. I guess as well, one thing to note with stocks, and let me just pull up the chart, is notably actually the S&P 500's forward PE that briefly touched levels only seen during the dot-com bubble and the 2020 pandemic surge. So chart-wise, you can just see here, this is the S&P 500, so solid, really solid, of course, very strong, really, ascending channel, bull channel, bull channel, sorry. Series of higher highs, higher lows. We've got in here, actually, we put in a sort of fib level from the lows in July, and we sort of tapped this first retracement level, the 23.6 minor level, really 65.81 there, and then we just bounced off it and we're moving higher again. So possibly first level of support around there. Of course, then the record highs just below 6,700. Similar chart on the Nasdaq. Haven't quite put in the fib levels there. Got an underlying upward trend line. 50-day moving average is that blue line, so that's well below at 23,658. And then you've got the record high from last Monday at 24,781. The Dow, similar uptrend, of course. That spike high was interesting from last Tuesday. Slightly negative, sort of bearish pin bar sort of candle. So a spike up to new fresh highs and then finishing lower on the day. That high at 46,714. But we found support around the sort of 46,000 area, and we're just above that now. The blue line, as I say, the 50-day moving average, that's well below, just above 45,000, tallying with that previous record high in February of this year. Okay, moving on from stocks then to last week's main data points. We have PMI data and US core PCE data, the Fed's favored inflation gauge report. On the PMIs here, you can just see, Reuters haven't updated this as a Reuters chart. Just to let you know, of course, Matrix actually August numbers, and then obviously we have the September numbers. Euro area, the ones probably mostly focused on. They came in largely as expected, actually positive surprise in the services sector, offsetting weaker manufacturing data. That saw then the composite edge up actually to, where are we? From 51.1 to 51.2, very marginal uptick there. And that was driven by that services activity, which picked up to 51.4 from 50.5. As I said, manufacturing was weaker, actually dipped below the 50 sort of contraction expansion level at 49.5, down from 50.7. Really all highlighting resilience in domestic demand around services, of course, and that possibly suggests actually a stronger than expected Q3 growth number. Price pressures, they remain subdued. Euro area price indices easing slightly actually in September. So yes, as we are really with possible slight uptick in the services growth, as I said. UK PMIs then, they came in weaker than expected actually. The composite falling from 53 in August down to 51.0 in September. Both services and manufacturing declined. Those services remained in expansionary territory at 51.9. Price indices, they eased marginally. And the employment index stayed pretty weak, actually, 46.6. So not a great sort of forward picture for the UK. These are, of course, business surveys, so forward-looking data. And yes, pretty weak on the UK side. Then just touching on the US, more focus is on ISMs, which we do get this week, of course. But PMIs, they came in slightly softer than expected. Manufacturing declined from 53.0 to 52.0. Services also dropped. But generally, US data was sort of pretty decent overall. Just checking out the prices data, that fell notably actually manufacturing, while services output prices also declined, indicating potentially actually easing inflationary pressures there. So those were the PMIs. We also got inflation data out of the US. Just moving on to that, you can see this Bloomberg chart just showing a little pickup actually. So numbers came in pretty much as expected, both for prices actually and real consumption growth, 2.9%, the core PCE number year on year. as I said, it's the Fed favored inflation gauge, the metric they follow mostly, and it tends to be lower actually than the CPI data, which is usually published, of course, in a few weeks. A few weeks earlier. So that's the Consumer Price Index. This chart here from Bloomberg actually just shows you what some economists prefer, which is the trimmed mean version of PCE that basically excludes outliers in either direction. That version you can see is steady, slight tick up actually, and the highest actually this year. And it's getting close to the upper band of the Fed's target range. So just bear that in mind on this slightly different measure that a lot of economists like to look at. Of course, doesn't mean we're not ruling out more rate cuts, of course, but generally the central bank will need a good reason for to obviously go ahead with that, and that's then over to the employment side, which obviously we're going to look at now. We did get, interestingly, just as before I go on to NFP, we did get jobless claims, obviously, hitting multi-month highs recently. And that suggested potentially joblessness was at last breaking out higher. Initial jobless claims are weekly data, those, of course. Just remember that every Thursday, so they'll be watched out for, of course, this week as well. But they are noisy, and actually the readings came back down to more normal levels after that print, and it was probably due to Texas, I think, claims, fraudulent claims there after the weather event. So initial jobless claims, actually that more timely data has pulled back to more normal levels now. Just moving on then from this to, of course, then non-farm payrolls. Just got a graphic here with all the numbers that are expected. So 39,000, I think, is the Reuters print. I think consensus slightly higher than that, closer towards sort of 50,000, but that number will change through the week as we get those job vacancy data numbers out on Tuesday, and then we get ADP numbers out on Wednesday. That all gets printed, gets released all ahead of course, Friday's number. ADP numbers, just for your guide, it's interesting actually because they have been dismissed historically in the past because they don't have a very high correlation with the NFP headline print. But since we've had those official employment revisions, then ADP has had sort of fairly decent predictive powers potentially. And even some Fed officials like Waller, who is the Fed chair frontrunner actually, he has said weekly reports received from ADP have showed continued deterioration, and that is what we've seen in some of those official revisions, of course, of non-farm payrolls. So just bear that in mind with that Wednesday number coming out, ADP private payroll releases. As for expectations, 39,000, then Reuters consensus otherwise, I think slightly a touch higher, but that will change through the week. Unemployment expected to remain steady at 4.3%. Remember, the Fed expect that jobless rate to pick up to 4.5% by the end of this year, before then easing actually to 4.4% next year and 4.3% in 2027, before then settling around 4.2% in the long term, just for your guide. Wage growth, that's seen at 0.3%, pretty steady now. Inflation expectations, wage growth expectations, average hourly earnings, pretty steady, has been for the last few months now. And then expectations, rate cut expectations by Fed funds futures, pretty much nailed on for another 25 basis point cut at the Fed's next meeting at the end of October. Then we have one last meeting in December, and there is a pretty high chance of another cut there, a 25 basis point move priced in, around a 68% chance of that happening, which means around 17 basis points priced in for that next cut in December. Bottom line, of course, payrolls growth has slowed sharply. And again, those recent benchmark revisions have suggested the softening is coming from a far weaker position than previously thought. I mentioned that earlier. And then the Fed, of course, has pivoted then its attention to the labour market weakness, that side, maximum employment side of its mandate, much more so now than the price stability inflation side of its mandate. Therefore, increased attention on this report, of course. Interestingly, Fed Chair Powell, he estimates, I think he said, between a break-even rate between for the headline of 0 to 50,000 is needed to keep the unemployment rate steady. That means there could be some focus on, again, the unemployment rate as well. And certainly we had that a few months ago, but then we had those big revisions as well. Yeah, that's pretty much the non-farm payrolls report. Obviously, if we just look at a few other charts, you can see that 39,000 print there compared to the 22,000 previously, and obviously the previous few months across the last year or so. And then unemployment as well, 4.3%. Used this chart before actually, but you can just see that pandemic high, or the high in the back end of 2021 at least, was 4.5% there for the unemployment rate. Powell, just for your guide, he sees unemployment as low and potentially influenced by, of course, immigration and possibly tariffs as well, although payrolls are weakening. So interesting with focus potentially on the UE rate as well. As for the dollar, let's just pull up the chart, then the DXY chart, which is, of course, the dollar against 6 of its major trading partners, with the euro having by far the biggest weighting in this index. Interestingly, dollar bears, of course, you can see here, suffered over the last week or so after interesting sort of stronger data and sort of reining in slightly of rate cuts going forward. Standout numbers, sorry, just to touch upon this, was the upward revision to Q2 GDP data, which showed much stronger US consumption than previously believed. As I said, we also got that lower jobless claims figure as well, enough to really shake out some late dollar short positions, really. Obviously, we've had gains in US stocks continue, and that sort of sees a sort of sense that global passive equity funds really following benchmarks will have to pour more money into the US going forward. So dollar-wise, you can just see, yeah, we've got this near-term downward trend line, which we didn't quite get to. We've got the 100-day moving average, that grey line, that's at 98.32, and then the blue line below there, just where we're trading around at the moment, which is the 50-day moving average, that's at 98.02. So interesting turn back, and now a downturn, if you like, although we didn't get quite to that short-term downward trend line. And then you've got, obviously, the most recent low at 96.21, then that low from June at 96.37. And if I just put this back, then you've got a long-term upward trend line from lows in 2011 and 2021. You can see there that thick dotted black line, which comes in around we're around 96.85 or so. So yeah, some interesting trend lines to the upside and downside on the dollar index. We also have, of course, the RBA meeting on Tuesday, tomorrow. Widely expected, basically, to leave the cash rate unchanged at 3.6%. The next 25 basis point cut, not fully priced in actually until March of next year. Meeting will not include any updated forecasts. So recent data then since the last meeting? Well, we had an upside surprise in the August monthly CPI data, 3% versus 2.8 prior. That's kind of tempered the case for near-term easing, at least, although the trimmed mean did ease actually 1/10 to 2.6%. RBA pretty much unlikely to overreact to 1 month of stronger data, given the broader outlook. Inflation outlook remains consistent with the target, while the labour market is gradually loosening, which all means policy need not remain restrictive for an extended period. Bottom line, really unlikely to rush into rate cuts anytime soon. Wait and see stance probably expected ahead of then the Q3 CPI data release. That's at the end of next month, actually, October 29. And Governor Bullock has actually said she emphasised that as a key input to future decisions. Rate cut wise, actually not fully priced in, as I say, till next year. And the November meeting was highly priced for another cut, but then that stronger inflation data came out. Now it's around a sort of 50-50 coin toss, actually, between a cut and a hold at that November RBA meeting. So little forward guidance really expected here. Maximum data dependence really with the wait and see stance going forward. If we look at the Aussie dollar, just let me grab that chart. We did push up to multi-month highs going back actually to prices in October of last year. That high was at 67.07. We just pulled back now back into this sort of range again. You've got support potentially at the blue line, the 50-day moving average, that's at 65.39. Then the grey line just below that's at 65.17. That's the 100-day moving average. We've still got here these fib levels which are working, it seems. So the 61.8 of this move lower, that's at 65.49 as well, where we're trading just about, and found support there. As I say, then that cycle high, swing high potentially just above 67. That's in Aussie dollar. Moving on from that, then we also get some Eurozone inflation data. Let me just put up the euro dollar chart, which is here. So let me just drag that out. Yeah, so Eurozone inflation, that's due on Wednesday. Expectations for the headline to rise to 2.2 from 2.0 actually, and then the core seen steady at 2.3%. Services last time around that slipped from 3.2 to 3.1% year on year. And that was a pretty steady report actually last time around, with the headline holding at target for a third straight month. This time around, possibly volatile elements due to energy prices, really, an uplift there, and also services prices due to tourism related costs could see a pickup, but that's not really a change in the underlying trend. Underlying price pressures, they likely remain pretty similar to those seen in August. So nothing undue to be concerned about here for the ECB. They are, as I said, likely to stay on hold for some time, actually, absent any sort of marked deterioration in the Eurozone growth outlook. I think there's only around 2 basis points of rate cuts priced in by year end. So really we need to see, well, a higher number, hotter number, if you like, on the inflation front to rein in those expectations, really, of one final cut this year, really, and that would potentially help the euro. Just on the chart then, euro dollar, the blue line again, acting as support, that's at 116.79. We've got some near-term fib levels in here as well. The halfway point of this move higher, that's at 116.55. That looked like decent support actually from last week. And then we've got a near-term fib level at 117.17, and then that multi-year high at 119.18. So that's Eurozone inflation data. I said we'd look at the yen as well, so let me pull up that chart which has seen, well, weakening in the yen versus the dollar, at least, with obviously this dollar strength and a pickup in yields, really, treasury yields. Could be interesting a few days and week or so for the yen, of course, and Bank of Japan policy as well. Wednesday, we get the Tankan survey, which is closely watched indicator, really, and has sort of picked up a little bit of attention after one of the Bank of Japan members said the September data could be extremely important. He mentioned that in a speech last month. Of course, markets are looking at the odds of a October rate hike by the Bank of Japan after the mildly hawkish pivot a few weeks ago by the Bank of Japan. We also get speeches from Governor Ueda and Deputy Governor Ushida in the 2 days after the Tankan on Wednesday. And some banks have speculated it could be a coordinated effort to prepare the market for tightening. So watch out for that. Certainly, if the Tankan is bullish, then that'll be interesting. Of course, the Nikkei 225 at record highs pretty much. Japanese government bond yields also at their highest since 2008. Should also mention that LDP election on the 4th of October, the Saturday, with the two main, the only two runners for that race. Takaichi, of course, is a monetary policy and fiscal policy dove, really, just against Koizumi Jr. So again, that will be of interest for the yen, although Takaichi has, I know, last week just sort of backtracked slightly on that sort of dovish nature going forward and said she will let the Bank of Japan do what it needs to do, I think, pretty much. So dollar yen picked up actually and got to the halfway point actually of this move lower at 149.37. Again, possible resistance around there, and we just turn lower. The black line is the 200-day moving average. That's at 148.41. So interesting, that capped the upside previously. So interesting whether that is support now or resistance again. Then you've got the 38.2, which is at 147.13 of this move lower. And then just below here, you've got the 100-day moving average sort of capping the downside-ish over the last few months or so. That's now at 146.45. Okay, I don't see any questions from you guys, so hopefully that's been helpful to everyone. Really do appreciate you being on the call for 33 minutes or so. Busy next couple of days. I mentioned the ISM data, of course, that US employment data in the run-up to non-farms jolts and ADP, as I mentioned. ISM data out on Wednesday, manufacturing that is, and then services after non-farm payroll on Friday. So a lot to look forward to actually, and watch the volatility certainly with the non-farm payroll report. Yes, so take care out there, and we will speak to you actually not next Monday, actually next Tuesday of next week. Okay, we will speak to you then.